Hey, this is Zach, and you're listening to Bitcoin Well Spaces for May 14th, 2026. The yen has lost a third of its purchasing power in 5 years against the dollar. The Bank of Japan owns half of their own bond market, and every other reserve currency seems like it's on the same trajectory. Look, I'll be honest with you, yen macro is not my strong suit. I've done some reading and I've got the broad strokes, but I am not the macro analyst on this panel, which is why I've pulled Roberto Rios, aka the Peruvian Bull, and Robert of Infra. Probably it's the two smartest people I know that actually understand this stuff. So today we are talking the yen, the gold bid, the dollar's next chapter, and where Bitcoin fits into the middle of all of this mess. Roberto, I'm going to let you take it before I put my foot in my mouth. Where should we start, man?
Yeah, sure. I mean, obviously, I think one of the easiest places to start is, what's happening right now with the interventions in the foreign exchange market for the yen, but also the broader issue that Japan is facing in terms of their energy security and their, domestic bond market and their fiscal situation. The last 2 weeks have seen a pretty incredible, series of events for Japan. On the 30th of April, so just about 2 weeks ago, Japan deployed around 5 trillion yen, around $30 billion to defend the currency in their foreign exchange markets. And they followed that up with what looks like to be highly likely another intervention on May 6th. Now, that intervention is not confirmed, only the first one is. But analysts from Bloomberg who track the BOJ's money market fund accounts and some of their other capital accounts noted a huge amount of flows on that day that would coincide with intervention. And there was obviously a huge leg down in USD JPY. But so we've had basically, given that, I think there's enough evidence to say it's likely that there's been two interventions totaling around 8.5 trillion yen, which is around 60 billion US dollars. For reference, that's not as much, but close to the amount that was spent for all of April and May and June of 2024. To give everyone else a recap, Japan has been facing a weakening yen since 2022 when the Fed started their hiking cycle. And this weakening yen has gotten significantly worse, especially as the spread between U.S. interest rates and Japanese interest rates exploded right over the course of the COVID epidemic. And that forced, obviously, carry trades to open up. And those carry trades went functionally short yen, long dollar, because there's a huge interest rate differential and they can take advantage of 0% rates and borrow in a cheap currency and lend in USDs and make a killing. But unfortunately, what that means is that the yen got clobbered. And so it's gone from about 100 to the dollar to where it sits now, which is about 157, 158. And they started their first interventions in September of 2022 with about a $50 billion bazooka fired on September 18th of 2022, which was the first time that they'd intervened since 1997. And they followed it up in October with more interventions. And when those didn't work, they decided to start moving their interest rates up. So they first were moving the bands on yield curve control, and then they were hiking rates, and then they moved out of the zero bound, and then they finally hiked into positive territory. And in 2024, they did this again multiple times, burning through, $65-70 billion in just the space of a few months. But the reason why I wanted to, talk about this today on a panel and bring everyone's attention to it is because it looks like the effectiveness of these interventions is getting worse and worse. Like in April and May of 2024, when they would deploy $30-40 billion, it would at least buy them, a few weeks, right? Even up to a month of time. So USD JPY might be slammed from like 155 to 150, and it would take the course of a month or two to kind of drift back up to the red line, and then they would intervene again. But as you can see from, if you just look at a TradingView chart of USD JPY, these last two interventions that they've done, the move is 50% retraced within 6 or 7 days. And so the effectiveness is going down significantly, which tells me that there's, more than just the normal carry trade pressure being put onto the exchange rate. The other thing to note is that there's some analysis from from Bank of America, B of A, and they put out a note saying that for the last 4 or 5 interventions before this one, for every roughly 1 trillion yen that was deployed, around one was taken off the USD/JPY. So let's say, this recent intervention, they deployed 8.5 trillion yen. We should have seen USD/JPY go from 160 to 152 or 151.5, right? If you just do 160 minus 8.5. So just one tick on the USD/JPY for every 1 trillion yen. And that was historically true. With this recent intervention, we only got to 155, 156. And so the effectiveness has been cut in half. So not only is the time to get back to the red line decreasing, as in like the market is pushing it back up, the actual effectiveness of the intervention is lessening. And so it's concerning, right? Because Japan is essentially the largest global sovereign creditor. They own a huge amount of foreign bonds, primarily U.S. Treasuries. Their foreign exchange accounts, it's at like $1.2 trillion, mainly held in U.S. Treasuries. They're also the largest sovereign funder of basically Eurozone debt, Canadian debt, Australian debt, almost all of the developed world, and they even lend to undeveloped economies. Just because the Japanese investor, for whatever the better part of like 35 years, hasn't had any interest rate domestically to earn a yield, so they've gone abroad to look for that yield. So they're kind of in a pickle right now, and I think the recent interventions just show that we're slowly inching down the road towards the yen game.
Yeah, coming at it from a layman, like I'm curious what to kind of get like my orientation here. Like I understand what the US is doing, how inflation is destroying the dollar, and also how it's kind of offsetting that by getting other countries either by force or convincing them to use the dollar so that we don't feel the inflation so much. And then that's also being compounded with stable coins. So I'm wondering how Japan, what they're doing, how that kind of compares to the US. So maybe I can kind of orient myself a little bit. And then also separate from that, maybe Robert, if you want to take some of this too, how is what the US is doing with stable coins and the popularity of US based stable coins? How are other countries and central governments reacting to that? Because I haven't really heard a lot about that or seen a lot about that, but it has to be having an effect.
Yeah, on the stablecoin note, I would just say, it's, I think, a futile attempt at instilling demand for dollars. And remember, when we talk about the dollar as reserve currency, what we're really talking about is U.S. Treasuries, interest-bearing dollars with a expiration date. And for the longest time, Japan, as mentioned, runs a very large current account surplus, especially bilaterally with the US. China is another one. We also run deficit with Europe, kind of in aggregate. So by definition, these countries were providing credit to us, right? For every dollar that is in a current account surplus, there is a dollar coming in to the country. So the current account deficit, there's a dollar coming in. So we relied on foreign or external financing. And, people were happy to do it. U.S. Treasuries were in a bull market for, 50 years, 60 years, and yielding, enough interest for the rest of the world, for foreign FX desks to allocate to U.S. dollars. We hadn't yet seized, defaulted basically on any of our legal obligations. So there was no indication, that we would pull any kind of funny business. That all ended in 2022 with Russia. But it was the safest, the cleanest dirty shirt. But then 2022 happened. Then, of course, we also had a bond bear market start. And it's continued. If you look at something like the 10-year, the 30-year, the longer end of the yield curve is down, significantly. So from a foreign allocation perspective, the U.S. Treasury is not necessarily holding its value in real purchasing power terms the way that it used to. We've also gotten dollar weakness since early 2025, which has kind of started to appear like it's starting to abate, but that has not helped either. So, when it comes to the stablecoin, what they're trying to do is they're trying to find if if foreign demand for 10-year, 20-year, 30-year, if that is drying up, which it is, we can see that going back to the Biden administration with activist treasury issuance. Even Yellen could see that. If demand at the long end of the yield curve is starting to dry up, and really the only demand for U.S. dollars or U.S. treasuries, interest-bearing dollars, is at it basically in the cash market, right, in T-bills, then that's where we're going to finance our huge astronomical deficit of about 1.8 trillion over the past 12 months. Over a rolling 12-month basis, we're running at about 1.8 trillion. We're going to finance that in T-bills. Well, the problem with doing that is you're running the emerging market playbook of, T-bills just follow the Fed, right? The overnight rate, basically, with little variation. So you just issue all of your debt in the cash market, get the central bank to cut interest rates, and voila, the T-bill yield will fall to, very close to whatever the overnight rate is. And, you got a lower interest rate on your debt. Now, that's very bearish for the dollar, in my opinion. It's also very bearish for the dollar in real purchasing power terms, but that is clearly their intention. Well, what the stablecoin market, at least, kind of, I am not a stablecoin expert, but my understanding was the intention was always that the stablecoins buy T-bills, right? Every dollar that flows into a stablecoin, the issuer, USDC, Tether, whoever it may be, they go out and they buy a T-bill. So that is kind of artificial demand for T-bills, but it is not without consequence, which is we are financing our government. The prior or current reserve currency is financing its huge astronomical fiscal deficit in the cash market at negative real rates. Right? That is the other key component of this is in order to get the fiscal under control, they have to get real rates to be negative. So inflation adjusted, right? You take the 10-year, you minus out inflation. You take the 3-month yield, minus out inflation. If the yield is below inflation, the bondholder is getting screwed. That is financial repression. That is, though, how you get out of a debt situation. And that is clearly what they are going to try to do. Long end rates, the curve might be, 200, 250, maybe even 300 basis points steep if you look at like 2s, 10s. But they're going to be issuing primarily in T-bills. But they need, a sucker to buy that debt and to suffer a real purchasing power loss. Now, this is part of the reason I'm kind of bearish, more skeptical on the actual amount of demand that is going to come into T-bills from stablecoins, because again, it's pretty clear that we are headed to negative real rates. So, how much demand really is there going to be for someone, overseas to, buy a T-bill at, basically at call it 50 bips, 100 bips, when inflation is 4, right? Because you are guaranteed to lose money. And not only that, but because we're issuing so much of our debt in the cash market, the dollar weakness that is probably going to, continue, it means that your real return is actually even lower. So I'm kind of skeptical when it comes to, people talking about $2 trillion of demand and all this kind of, I think it'll be much closer to somewhere in the neighborhood of 200 to 400 billion of actual net new demand, because you remember that that is really what matters. If you're shifting from I got a bank deposit at Wells Fargo and they're basically on the other end in money markets and repo and whatnot, and getting interest at the short rate. If I just take my deposit and get a T-bill through a stable coin, basically, that's not really a net increase in demand for for debt, for the U.S. Treasury debt. So I think that net increase in demand is really what to watch, not the total amount of inflows into stable coins, because again, we're going to have negative real rates, which like by definition means if you are buying this stuff, you are guaranteed to lose money. And not only that, but there's going to be dollar weakness associated with the fact that we're running kind of an emerging market playbook of financing a huge deficit in the cash market at negative real rates. That is immensely dollar negative, in my opinion. And to your question about other countries, I think that this is going to kind of lead to a bit of a race to the bottom sort of mentality, beggar thy neighbor. And I think all of these kind of dynamics are going to start to rear their head again if they make a concerted effort to really do this. Right now, Fed funds is 3.25, 3.33, kind of in that range, and inflation is barely above that if you look at CPI. But if you look at PPI, which leads CPI by about 2 months, we're headed to 4.5, 5, 5.5, 6, right? And so then all of a sudden we are talking about very negative real rates, which should be good for Bitcoin, should be good for gold. Historically, that correlation has held. But to your question, it's going to lead to a dollar that becomes too weak, right? And Switzerland, for example, this happened maybe 9 months ago. The dollar franc exchange rate, that dollar Swissy, it was getting too weak. And they didn't like that. They didn't want their currency to be so strong. So what they do, they artificially, basically yield curve control down into negative nominal rates to try to weaken their currency and disincentivize foreign inflows. So I think that gold and Bitcoin can absorb some of that, when it comes to kind of global reserve asset allocation. But yeah, quite kind of nuanced topic.
Yeah, I think it's important to note what you're saying from the beginning, right? Like, yes, there's going to be obviously an incremental increase in stablecoin demand, and that can help fuel T-bill issuance. But the issue is that the supply side just overwhelms the demand, right? The most aggressive estimate is for $2 trillion by 2030 in increased stablecoin demand. But that does not, that's like one of their most optimistic scenarios that basically takes the 2021 growth rate and extrapolates it from now. If you look at the more conservative ones, it's what you said, it's like $300 to $400 billion. And you compare that against the net new issuance of T-bills annually. So not overall issuance, because obviously overall issuance annually, the Treasury does between 20 to 25 trillion dollars in gross T-bill issuance. But a lot of that is just rolling over the prior maturities, right? So when we look at just net new issuance, in 2025 is around $330 billion of net new issuance. And in this year, it's going to be 555 billion. And so it's increasing rapidly every single year. And that already outstrips, obviously, the stablecoin demand of around 300 to 400 billion that's been estimated by 2030. And if we continue down this path, right, you're going to see more and more strain in the treasury markets and more, push towards that issuance on the front end, right? Because that's really where the most liquid and most available capital is. The ultra long end is obviously much more, especially for like a long investor, like a macro investor. That's a much more difficult sell, especially as we go into this, kind of uncertain geopolitical environment with the Iran war, with what's happening in Ukraine, with what's happening in the Strait of Hormuz, and it also is important to note, right? Like, there's not only does Tether and Circle and all these other large stablecoin issuers hold T-bills, Tether's also been accumulating gold at like an extremely rapid rate. As of 2026, they're late, or yeah, it was a Q1 2026, their financials, they were reporting 154 metric tons of physical gold, which is $23 billion. Now, that's a lot of gold. That puts it in the range of the top 20 of global central banks, and it puts it right behind Brazil as if it were a nation state, as a gold holder. So just one entity, one corporate entity that is supposed to hedge all of their, let's call them like, you could call them like quasi euro dollar liabilities, aka these stable coins, hedging them by owning T-bills. They're purchasing as much gold as they can get their hands on. And so if that isn't a signal to tell you, what the sentiment is, especially among institutions and among higher level risk managers. I don't know what is.
Yeah, every 5 days, the net new issuance, is mainly a function of the deficit. But in terms of the amount of actual T-bill refi, the true kind of gross refinancing in T-bills, it's enormous. We're talking like $500 billion every 5 days. And it sounds crazy, but I triple checked that number when I heard, I think it was Luke Groman that pointed that out. This is part of the reason, by the way, that we can't necessarily, or Kevin Warsh won't be able to draw down on the balance sheet, is because in order to do that, you would have to draw down on one of the liabilities of the Fed. Bank reserves can't do that, right? We're right about 3 trillion, 2.9. And we're at levels that last Q2, Q3, Q4 kind of 2025. At these levels, 2.9 trillion, we were having major issues in the repo market. SOFR spreads were blowing out, and the issue there is $3 trillion gets financed there every day, right? And that's where the basis trade is financed. And the basis trade is responsible for about 40% of demand, according to the Fed themselves. I think it was like 41 or 42% of all new U.S. debt issuance going back to 2022 came from a bunch of 50x, 100x levered hedge funds in the Cayman Islands in this basis trade. So they can't afford to let the repo market blow up. Therefore, they're not going to allow bank reserves to decline too much. TGA, due to the amount of T-bill rolling, redemptions that come to, T-bills that are coming due every 5 days that need to be rolled. I regularly watch every day, there will be a $90 billion T-bill auction, right? There is such an enormous amount. They can't allow the TGA to decline. The RRP is basically empty. So, this is part of the reason I don't think that I think that the concern over Kevin Warsh and his perceived hawkishness with the balance sheet is misplaced, because what liability are you going to be able to decrease?
Yeah, I know it's one thing for an incoming Fed chair to say that they're going to reduce the balance sheet and reinstate monetary austerity and make sure that we don't have continual monetization of financial assets. And it's another thing to actually do it, right? I was obviously around in 2018, 2019, and I remember hearing Powell say, before he got in I think it was early 2019, that he was going to, not increase the balance sheet and he wouldn't reverse the drawdown in total balance sheet assets, which was happening in the second and third and fourth quarter of 2018, which coincidentally caused a equity market correction in the fourth quarter of 2018, where SPY dropped 20%, Russell 2000 dropped like 25%. We entered, bear market territory briefly. We had the worst December on Christmas Eve, I believe it was, December 24th. We had the worst single day since the Great Depression in terms of stock market performance. And then obviously, in short order, by January, Powell had come out and said, we're reversing course and we're going to, we're no longer balance sheet agnostic and no longer market agnostic. We're going to listen to the market and we're going to stop the taper and reverse course. And so it's very easy, again, as an outsider for Warsh to say that. But once he gets his hands on the wheel, so to speak, I think it's going to be much more difficult. And that doesn't even bring up the point of his idea of this quasi monetary austerity, this quasi monetary responsibility that he's been touting of reducing the balance sheet while also lowering interest rates is going to be a high tripwire that's going to be incredibly hard to manage. Typically, the way balance sheet mechanics work is as balance sheet grows, you're able to lower rates, because by lowering rates, you're purchasing T-bills, bonds, mortgage-backed securities, whatever other assets you want, and driving down the rates of those instruments as you drive the price up because you're doing QE, right? And then the inverse is also true. As interest rates rise, you're letting balance sheets, or you're letting the balance sheet taper off. You're letting securities roll off. You're letting them expire. You're, not rolling them into new assets, and you're essentially destroying bank reserves in that process, right? And so what he's proposing is kind of a contradictory statement, right? Something, a scenario where he's able to lower the balance sheet and lower interest rates. um, you're going to have to use some sort of interest rate fixing adjustment, or some other form of liquidity provisions to make sure that that actually happens. Or you'd have to have very favorable macro conditions. And the problem is, obviously, as we know from the closure of the Strait of Hormuz, is that's not on the horizon anytime soon. And so I think it's going to be very difficult for Wars to pull off what he wants to.
Yeah, like I mean, I pointed this out in a video I just did, but I'll keep banging this drum. You look at the US and we are responsible, if you look in the aggregate globally, we're responsible for like 85 to 90% of the net debt, right? There are net creditors like Japan, like China, like Europe as a whole, the GCC, and then there's net debtors, and that includes, emerging markets, but it also includes the US. We are a huge net debtor requiring external financing. And, that's one thing when Europe and developed Asia are running current account surplus and everything is good, because by definition, what that means is they are providing credit on the other side, just double entry accounting. On the other side of that current account surplus, they are providing credit to the rest of the world, so including us. So that is okay. It's a whole other thing when they have energy inputs, which they are all heavily reliant. Europe and then developed Asia, they are all heavily reliant on energy inputs for their energy needs. Well, when the price of energy doubles, their current account surplus, if they had one, France, Great Britain, some of these countries kind of already run a twin deficit, but if they had a current account surplus, it is turning into a deficit, meaning that they are turning from a creditor who might be buying US treasuries, might be buying hyperscaler debt, right? Google Meta bonds, into a debtor where they are having to find financing for their government and their kind of fiscal operations and needs for their country. Not only that, but we had kind of with the petrodollar, the GCC was this huge, I think, underappreciated dynamic where they were kind of counter-cyclical, where Europe and developed Asia, where they might be subject to the whims of a business cycle, right? Global economic conditions. The GCC was not, right? There was always a demand for energy. You look at some of these countries, and more than half of their GDP, sometimes even two-thirds, comes from oil and energy, kind of broadly. So what that means is that they were very, very susceptible to, the Strait of Hormuz being closed. That makes them very, very susceptible to getting just absolutely obliterated. And for context, the U.S. runs about a 3% current account deficit as a share of GDP. In the early 1990s, Kuwait, obviously with the Gulf War, Kuwait, same story, right? The part of what ended up becoming the GCC. They, huge focus and reliance on energy. With the disruption of the war, their current account deficit went to negative 240% of GDP. They went from, I think it was about a 15-20% surplus to a negative 240% current account deficit. So that is what can happen to the GCC. And they were always kind of a counter-cyclical sort of ballast or buffer, right? Europe and Asia, developed Asia, they might be, not doing too well like they are now with energy doubling, right? Getting pushed into deficit, or at the very least, in the case of Japan or China, at the very least, less of a current account surplus. While they might be struggling, you had the GCC that was kind of this buffer, right? There was always some amount of demand, meaning there was always export revenues coming in the form of dollars that could then be recycled into U.S. treasuries, right? That was the whole petrodollar agreement was you price your oil in dollars, you receive an immense amount of dollars every day, every month, every year, and then you recycle those dollars back into our debt, and that has dried up. Not only has Europe and China, developed Asia, not only have they kind of turned into potentially less of a creditor or maybe even an outright debtor, but then you have the GCC, which was kind of our last remaining ballast of constant kind of demand for U.S. Treasuries. The Strait of Hormuz is closed, and Saudi Arabia, which has the Yanbu pipeline, right? Saudi Arabia is in a better spot than most. Even their export revenues fell by 50%. And that was just so far, could fall even further from what I've read. So, there's a real issue on a balance of payments kind of basis that I don't really hear many people, if any, talking about. And it's going to have an effect on not only the U.S. Treasury market and this huge amount of financing, but also, of course, with all the debt, investment grade debt that is coming due to be refinanced, and the new issuance coming from not just the hyperscalers, but kind of existing investment grade corporate debt issuance. There's a huge amount of debt and mortgage backed issuance, right? Just kind of normal municipal issuance. There's a lot of debt, and there's very little balance sheet capacity in the form of foreign current account surplus, because again, Europe and Asia are very sensitive to the price of energy, which just doubled, pushing them, pressuring their current account. And then the GCC is, being decimated. I mean, they're going from like 25% current account surplus to probably a deficit within the next month or two if the Strait of Hormuz remains closed. What that means is, by definition, that credit, foreign financing of our various, financial instruments, debt, our overconsumption here in America, that financing goes away. Then what happens, right? That's the part that I don't think enough people are talking about.
Yeah, and to add some color to that, especially for Japan, I had a recent Substack piece called "Last Warning," where I was talking about the Japanese energy security issue, and the numbers there like exactly mirror what you're saying, Robert. The Actually, since around 2020, Japan's had a negative current account or a negative trade balance, I should say. Um, the reasons are probably complex, but part of that is the energy story. Part of that is data. They actually, this is something I learned from Weston Nakamura. They import around $7 trillion of data services, meaning like cloud hosting and streaming services, from the West, mainly the US, but also Europe, every single year, because they just don't have much of the infrastructure built domestically. So that's a large part of the reason why their trade balance is negative. But it's around negative 200 billion yen on average from around April of 2025 to February of 2026. And after the closure of the Strait of Hormuz, it skyrocketed to negative 1,200 billion yen, so 1.2 trillion yen in the black, or in the red, I should say. And so that means that obviously, like the Japanese, the Japanese domestic manufacturers and the Japanese domestic, traders and merchants and commercial banks that have exposure to clients who use the international markets are seeing immense strain. And that strain is showing up obviously in USD JPY. We're seeing like I said at the outset, the resilience of USD JPY is much, much stronger than it was even just 2 years ago. The overall trade balance deterioration and the interest rate bifurcation has still remained. So, not only do we have this energy story, but we have this, you could say elevated spread between the U.S. 10-year and the Japanese 10-year that has basically remained for the last 5 years, and this last April BOJ meeting and the recent Fed meeting also confirmed that, where both central banks held steady on rates and didn't hike. Although the recent BOJ meeting actually had the largest dissension, and I believe in modern history. I don't know if it's in all the total Japanese history, but they had 3 dissenters out of 9, and 3 of them wanted to hike to 1% immediately and then potentially go higher from there. But Ueda kept it steady at 0.75%, and he also signaled on April 28th that they weren't going to likely hike rates at the next meeting. They're likely going to hold again. And so, Japan is dealing with not only obviously this yield problem, this interest rate differential in the carry trade, but the energy issue. And the energy issue is not something they can fix easily. I mean, they import around 85, 87% of all energy, of all primary energy. They import 90% of crude and 93% of total oil imports from the Middle East. And the vast majority of that is transmitting through Hormuz. They also have a huge reliance on LNG. Now, LNG is more complex, obviously, than just crude oil. In order to store it, the Japanese use cryogenic storage, so, cooled tanks, which are harder to maintain and more difficult to build than just normal, let's say tank farms that are used for crude oil or for refined gasoline products. And the issue is that 30 to 40% of their electricity comes from LNG. And so, unlike that crude which can be stockpiled easily and cheaply in tank farms, they don't have as much of a stockpile of LNG, and they're much more prone to LNG outages than they are to even just crude oil outages. Overall, they have like 254 days, I believe, at the outset of the crisis of crude oil reserves, and they already released around 60 to 70 million barrels as a initial shot to try to lessen the impact of the oil price in yen terms on their domestic economy. Obviously, that didn't do much because oil in yen terms has still continued to climb higher, but they've floated doing different things to alleviate the problem. Right, one of them has been even obviously the interventions in the foreign exchange market. So if they dump USD/JPY, then in yen terms, their dollar-based or dollar-denominated oil imports do get a little cheaper. But there's been recent statements from the Department of Finance, or Ministry of Finance, Finance Minister Katayama, that basically indicate that they're considering intervening in the oil markets as well, specifically using futures. So the way they do that is just use their oil reserves, right? Their version of the SPR. They'd go to a major market maker and they'd say, "Hey, we want to dump, 50 million barrels of futures in the paper markets," and they do that in short order. And they try to drive down the price and then hope that the people on the other side of that are just going to take cash settlement and not actual delivery. And so by doing so, they can use the paper market against itself and manipulate oil lower in yen terms and buy themselves some time. Now, I'm not sure. I don't think they have done that yet, but that's something that's been floated. The effectiveness of that has yet to be seen. I mean, if the foreign exchange interventions are any indication, it's probably not going to be the most effective option. But they're desperate at this point, right? Because even though they have that 254 days of oil stockpile, they only have 3 weeks of LNG. And because LNG is 30 to 40% of electricity generation, if this crisis isn't solved soon, they're going to start to face energy shortages. And this is also compounded by the fact that they're still dealing with an overhang of energy or of lack of energy from the 2011 Fukushima nuclear disaster, right? If everyone remembers, there was a tsunami in, I believe it was April of 2011 that hit Japan. It wiped out these backup generators at this Fukushima nuclear plant. The plant did not explode in spectacular fashion like Chernobyl, but some of the cooling rods failed and radioactive waste got out into the water supply and primarily in the ocean. And so there's a massive cleanup effort. There was an international panic about it, as there usually is with nuclear issues. And Japan promptly shut down most of their nuclear reactors. As of today, right now, they have 55 nuclear reactors. Most of these are decommissioned. They only have 13 that are actively running, and they have about another dozen to 24 that they're trying to restart. But the problem is, even with the restart efforts having begun, restarting a nuclear reactor is not something that you can do easily, right? It's not, you can't just go flick a couple switches and it starts back up. It requires at least several years of rehabilitation and refurbishment and checking all the safety mechanisms to make sure that it can be restarted safely and without issue. So even though they're in the process, they're probably a couple of years away at this point from restarting a large section of their nuclear fleet. And some of their older reactors are now that have been decommissioned for 10, 20 years are now basically defunct and need to be completely refurbished. And so that's even a longer time frame for some of those. So Japan is in this weird scenario, right, where whatever they do essentially makes the issue worse. If they intervene in the foreign exchange market, they're just burning through their dollar reserves. If they try to hike rates, then they're just worsening the problem on their domestic fiscal situation because they have 260% debt to GDP at the gross federal level. They have 122% private debt to GDP, so it's extremely bad even on the private side. And they're an economy that's just basically experienced zero growth for the last 35 years, right? I did actually a documentary with Weston Nakamura. If you know who that is, he's a great macro analyst for Japan. And in that documentary, he told me something that shocked me, but it also made a lot of sense. He was asking me, like, who is the Japanese Elon Musk? Who's the Japanese Mark Zuckerberg? And I couldn't name anyone. And he's like, exactly. He's like, the problem is Japan has no real domestic startup scene or founder scene. And as a developed nation, Japan has fewer founders than basically all of the OECD, including the lowest founding nations in Eastern Europe. And so, like, for reference, they have around 306,000 founders or self-described founders of businesses. Japan is a country of over 100 million people. And so that proportion is tiny relative to their economy. So the growth story just hasn't been there for decades, and it's unlikely that it's going to be there in the next few years to help rescue them from the situation. But it means that they're in this bind, and no matter what they do, no matter where they turn, the issue gets fundamentally worse because every intervention just burns through more reserves. Every hike in rates increases the debt issuance and increases the hole that the sovereign is in. And if they restart yield curve control, or if they decide to, instate some sort of quasi QQE like they did back in 2013, that's just going to worsen the problem on the financial side, right? That's going to restart the inflation issue, which is already bad. I mean, I believe the Nippon Index or the Nippon Group, which is a group that works with Nikkei and also is a market research and analysis firm in Japan, they released a forecast of 2.8% to 2.9% of CPI inflation for Japan. Now, that's for 2026. That's the highest inflation rate that it will have in the last 35 years. And so, if Japan is going to be able to weather that storm, they're going to have to do something drastic, and that means likely asking for some sort of using of the swap line, funding of the swap line from the U.S. Treasury from Basent.
So one ironic point or bullish defense of Japan and their situation, their version of the ESF, the Exchange Stabilization Fund, which is where this sort of intervention occurs, is called the FEFSA. Due to the fact that you have had the yen carry trade, we have to remember that Japan is long the yen carry trade, right? They were able to issue debt at zero or even negative interest rates and then buy U.S. treasuries. And part of the reason, by the way, that trade balance is that they run a trade deficit, but they run such an enormous current account surplus was confounding to me at first, because that's not necessarily super common. Generally, it's relatively in line with the balance of trade. But with Japan, they have run such large current account surplus for so long, and they have accumulated so many interest-bearing assets that they have this huge amount of net interest income, basically. And if you kind of make an equivalency to America, it would be equivalent to our ESF generating $600 billion per year of net interest income. That would finance a third of our fiscal deficit. Now, of course, America has not ever, not in our recent lifetime, run a current account surplus. We run huge current account deficit. as Triffin's dilemma. But so we don't have that, but it would be equivalent to $600 billion per year coming into our country as interest income that we could then use to finance. So when they're financing these interventions, I think that part is important to remember, that the reason there's such a huge delta between their trade balance and their current account is due to the amount of interest bearing assets they've been able to accumulate over, I don't know, 4 decades, 5 decades. And so that net interest income is really, really important, and kind of a positive, or buffer. But then there's also a huge, an even bigger unrealized gain that is about 50 trillion yen. And that is, again, a result of basically them being long the yen carry trade. So, Brad Setzer has kind of floated this, that, one thing that they might do is try to monetize that huge 50 trillion yen unrealized gain from the yen carry trade. The hedge funds were long the yen carry trade, made a lot of money, but so did Japan, and so this is a ballast or a positive, that I would always put forth. The other one is that, when you look at the debt, the headline number is what always gets reported. But if you look at external debt to GDP, it's still high, still, in my opinion, too high, but it's much, much, much lower than the headline figure of 250, 260%. And that external debt to GDP, I think, is really what matters. This is part of what screwed over Argentina so much, was the amount of their external debt to GDP and the debt burden, especially for the debt priced in dollars, kind of hard currency, quote unquote, debt. That was really what was burdening Argentina and a lot of emerging markets that get in bed with the IMF and do that whole kind of economic hitman thing. But Japan, their external debt to GDP is, last I checked, about 100%, which is, again, still very high, but much lower than the headline figure would suggest. So, if they start to monetize that huge 50 trillion yen unrealized gain, that's ammunition that they could use to basically short paper oil markets. You also have 5 trillion yen per year of basically net interest income that they can use to finance either currency intervention or this short oil futures trade. I think that they kind of have to hike, and because so much of the debt is internal, it's basically, I mean, it's kind of like crazy and Ponzi finance kind of stuff, but like it just gets recycled back to the Ministry of Finance, so that internally held debt. So as long as external debt to GDP doesn't rise materially, I would also point out that like one of the reasons rates started to move was like, they had the lost decades where they had negative wage growth, they had deflation, they had negative GDP, meaning their economy was shrinking. But they started to come out of that in 2021, 2022. They started to get heat into their economy, started to get positive wage growth, and then it was even more positive and more positive. Inflation started to really pick up. It's taken a dip over the past couple months, but that is mainly a government subsidy story. So if you look at what the inflation rate would be without government subsidy, it's about 3.1, 3.2, somewhere in that range. So inflation is definitely an issue, especially when you couple it with the energy story, the reliance on imports for energy, but also food. I think something like 90% on a caloric basis of their food comes from imports. So they really can't tolerate too much more inflation, I think. And so I think they're going to kind of have to hike. I thought that they were going to hike at the last meeting and got pretty close to winning a 30x Kalshi bet, but with the number of dissents. I do think it was a record number, by the way. I do remember reading it was a record number of dissent. So there's clearly appetite, I think, to hike interest rates. And I think that that's probably what they're going to try to do. But I would also keep an eye on that FEFSA and a potential monetization of huge amounts of unrealized kind of paper gains that they basically got from being long the yen carry trade and being able to issue debt at zero and then invest in U.S. Treasuries earning 3, 4, whatever it was. That is what gives them the ammunition. So, when you hear about the scale of a currency intervention, always put it into context of that 5 trillion yen per year net interest income into the FEFSA, and then the 50 trillion yen unrealized gain that, again, they haven't really tried to monetize, but if they really wanted to, they could. And we are entering a world of deglobalization, much more kind of multipolar, less globalized sort of cooperative sort of world. And so, I think that especially with a populist prime minister like Takaichi, I think that sort of prospect is going to gain political momentum within Japan. I'm not a Japanese political expert, by any means, but if I had to venture to guess, that is, I would say, something to keep an eye on.
Yeah, that's a good point, Robert. The gross number of the debt is obviously very, very shocking, being 260%, 250%, depending on how you measure it. But there's obviously those commonly cited figures that the BOJ owns 55% or 53% of all standing JGBs. If you include other government agency, the number etches up to like 65%. And owing money to yourself, owing money to your own agencies, owing money to your own central bank is a much different prospect than owing money to foreigners, right? So that's definitely correct, and that's a lever that they could pull, right? I think Groman even noted, one option for not only obviously Japan but even the U.S. would be have the Fed just zero out all the treasuries that it owns in terms of like actually owning interest on those securities. And that can alleviate, part of the debt problem. And as the central bank, obviously, even if they have nominal losses, they can basically print their way out of that, or they can use their remittances or whatever other, accounting mechanisms to overcome that. The other point about Takaichi is very salient as well, because, Takaichi took office in October of 2025 with this very populist kind of like, fiscal spending dominant, very Trump-like stance, not only on immigration, but on general politics, on nationalism. Right, she wanted to dissolve the old Japanese constitution and reinstate Japan's ability to form an actual military, because since 1947, under the MacArthur constitution, Japan was not able to have any meaningful military other than a small self-defense force. And, she obviously won that election by a landslide. And then she went on to basically promise broad fiscal reforms. And some of those reforms included things like cutting the 8% consumption tax that exists on basically all Japanese domestic consumables. So think about like food, beverages, restaurant stuff. Think about shopping at department stores. All of that is generally a tax on the consumer, and getting rid of it is a huge populist victory. But the problem is that it provides several trillion yen in Japanese government financing, right? And so getting rid of that is equivalent to getting rid of the budget for all of public high school in all of Japan. And obviously, as November, December, and January dragged on and her popularity was starting to come under fire, she decided to move forward with this kind of snap election. And she dissolved the lower house of parliament. And then on February 8th, she called for a snap election, which she won. And then promptly started to put into the reforms that she had promised, right? So cutting that consumption tax, increasing fiscal spending, increasing especially infrastructure spending, as well as obviously remilitarizing the Japanese defense forces, and basically reinstating the army and the navy and the other contingent branches. The issue is, obviously, this comes at a time when Japan is already under strain fiscally. And so I think that that's a large part of the reason for the weakness, especially in the long end JGBs. If you go look at some of the charts I've posted, I'll try to pull some of them up and put them in the nest. But if you look at the long end JGBs for the last few years, they've been absolutely blowing out. But even in just the last month, right, since 2025, we have since January 1st, looks like the 10-year went from 1.45% to around 2.4% now. For the 20-year, it went from around 2.5% to 3.45. For the 30-year, it went from 3.1 to 3.7, and for the 40-year, it went from 3.3 to 3.9, and actually 3.69. So it's almost 4. And so that means that that pressure on the ultra long end JGBs is continuing to build, and especially the domestic life insurers, which is something that Dario's pointed out, who own trillions and trillions of yen worth of these JGBs, are now starting to be in the hole. And again, this is another issue that is domestic, right? Yes, not many foreigners own JGBs on a net basis, right? I think it's only like 8% or 9% of all JGBs are owned by foreign entities. Although I saw a recent Financial Times article saying that the recent auctions for the past 2 years basically have been about 65% foreign buying, meaning like it's basically hedge funds trying to bet on on a resurgence of Japanese easy monetary policy and maybe a reinstatement of yield curve control ever since it was taken off the table back in March of 2025, I believe it was. Maybe it might have been 2024. But yeah, so that pressure has continued to build, and so domestically, like we said, Japan definitely has its issues, but like you said, they have a war chest to build on. Another interesting fact I learned while filming that doc with Weston is that 55% of all Japanese household assets are in cash, which is the highest of any developed nation by far. For reference, I think in the U.S. it's around like 3 to 4% on average. And of course, cash also means cash equivalents. So we're thinking about T-bills and short-term debt, not just pure cash. But that's a huge, huge stockpile of savings. And not only that, right? They have, like you said, the 5 trillion yen a year going into FSEA. They have around $7 trillion, I think, of overall cash savings just within the domestic economy, and obviously they own several trillion USD worth of U.S. equities, U.S. Treasury bonds, U.S. corporate bonds. They're essentially like the global piggy bank of the world, and so this isn't to say that they're collapsing. Obviously, tomorrow they have a lot of reserves to draw upon, but the fundamental issue of low growth and higher and higher inflation, which historically the Japanese have not experienced for a long time, still remains. And the main problem, I think, is even though there have been those wage increases that you've noted, the Japanese economy culturally, at least is what I saw when I was there, is very, very strict and rules-based and formality-based. So, for example, something that Weston told me is that if you're working a corporate banking job in Japan, right, and let's say you're a junior associate and you want to get a raise, you don't ask for a raise. You don't get to, basically push for advancement. The advancement comes when your boss tells you, because it would be disrespectful to push that onto your superior. So you basically have to wait for people above you to retire for you to advance forward. And the same is true of most meetings. Like if you want to instate a new program or something, they don't allow you to do that without written authorization from a superior. At least this is like the corporate, Japan culture that I was learning about. And so because of that, even though there have been wage increases, if you look at them nominally, they're pretty small, right? Like they're 0.5%, 1% after 2 or 3% inflation for several years. So it just culturally, like the Japanese are going to have an issue adjusting to high inflation because they're not used to asking for these raises and the companies aren't used to giving them. And so that mentality shift, I think, is going to take time.
I had just one question I wanted to ask Roberto. You guys are quite the experts on the macro side. Here you guys talk is teaching you quite a bit. And I wanted to ask, I guess both of y'all, Roberto, you touched down on this a little bit with talking about Japan and how they have very little founders. We think of, entrepreneurial founders, we typically think of like, adults that are maybe between young adults and middle age, which Japan actually has very few of. Just taking a look at some of Japan's population demographics, they got nearly double the amount of people over 65 compared to the United States, and half of the people under 18. So with this kind of like low workforce to old age population, do people have the ability to be founders? Is like the financial pressure too much, and is this demographic hole something that Japan can dig themselves out of with financial engineering, or what's their path forward to fix that problem?
I mean, like I said, it's an issue. It's a structural issue, right? Because it's not only demographic; it's also cultural, right? The Japanese are very risk averse, and so saving face is very, very important for them. During the 1990s, during their kind of like slow motion train crash deflationary collapse, right, where real estate prices continued to fall, the Nikkei continued to drag lower for basically the entire decade. You saw bank executives, corporate executives, lawyers, doctors all decide to, you know, do things like quit their job and leave to the countryside, or even do something as horrible as commit suicide, rather than admit that their company had taken on too many bad loans. And so culturally, it's very difficult for the Japanese people to, take risks and to fail publicly, right? That's one of those things that's seen as a huge, huge risk. And one of the people that we talked to was a Japanese YouTuber with like 400,000 subscribers who went around with me and Julian and Isa, and we were filming and talking to Japanese, just normal Japanese people walking the street. And he was telling us that it took him about 3 years of convincing his parents for him to basically quit his job and launch his YouTube channel full time before they actually were, able to believe in him and allow him to do that, because he was living at home at the time and not, throw a fit. And so, that this is a endemic structural issue, but I think obviously if the economy forces it, the economy will force it. And, not only the wage pressure, but the founder pressure, right? I think there's also measures that need to be made on the government side, on the regulatory side, to shift investor behavior back into risk taking and to promoting entrepreneurship and fostering founders and founder led organizations.
I think the cultural component, I think, is an interesting thing that I think it's easy to overlook, because you can Google all these statistics, but it's kind of difficult to measure or even really see that friction unless, yeah, like you kind of compile all these like anecdotal cases. And I guess as an outsider, right? Like I'm someone who hasn't experienced much of Japanese culture, so I'm more like I'm learning of this kind of stuff now for the first time.
Zach, do you have any other questions for us?
No, not really. That I was trying to actually throw that to Conrad, and he was able to jump in, so that was perfect. I mean, that was the only thing. Is kind of, I get maybe to take the opposite side a little bit. Japan's recent inflation, if you look at the numbers, seems mild compared to the West. Is it actually as bad? And what makes you think that it's at the crisis point now compared to like the past 10 years? Because it's been kind of getting slowly worse compared to the West over the last 10 years. What recently has caused it to hit the crisis point, and what makes you think that it's that they are in full crisis mode at this point?
Well, it's what Robert said, right? They import 90% of their caloric, food supply, and they also import 87% of their total primary energy, including 93% of crude oil. And this creates, I actually had a viral tweet about this about, I think it was like a month and a half ago now. It was like in late March, where I was basically laying out that, like, the primary reason why Japan uses U.S. dollars, the two primary reasons are to invest in, capital abroad, aka U.S. equities, U.S. bonds, U.S. Treasury bills, and also obviously use the dollar as an intermediary for trade with, the rest of the world. And so, and primarily the trade that they need to do, meaning like the vital, like things that are inputs that are needed for their economy, especially as a high-end manufacturing-based economy, is energy and food, because they don't grow enough and they don't have any real crude oil reserves or LNG reserves domestically. And so what that means is that when USD JPY blows out, right, let's say yen goes from 150 to 160, that means that their energy bill goes higher in dollar terms, which means, functionally they have to sell yen daily to buy dollars and then use those dollars to buy oil. And so that puts continuous pressure on USD JPY. And the higher that oil goes, that the more weakness is generally seen in USD JPY. In the last, I think it was 60, 70 days correlation, I did this on my Substack. I ran it through through Claude using some data from TradingView. The correlation between WTI crude, so the front month futures contracts, and the USD JPY exchange rate is 0.72. So very, very high correlation between those two numbers, which just shows you like this trade energy bill correlation is very much in play. If energy prices rise too much in USD terms, Japan has to use a bunch of their, a lot more yen to buy the same amount of dollars to get the same amount of oil, or even less amount of oil because it's more expensive, which just drives their foreign exchange market exchange rate even higher. And so it's just a feedback loop where higher energy prices lead into higher trade bills, which lead into worse exchange rate prices, which leads into higher energy prices in yen terms for the Japanese. And so it's just a continual feedback loop that just makes the problem a lot worse. And in every other respect, like we said, Japan has quite a bit of strength, in terms of overall, domestic production manufacturing, in terms of overall savings. Like we mentioned, $7 trillion of overall cash or cash equivalents, 55% of household assets, 5 trillion yen worth a year of net interest income. All of these are very good financially for the Japanese, but what does it matter if financial assets are higher if your food and your energy has doubled? And especially the LNG issue, I think, is something that they're going to need to solve quickly if they don't want to have energy shortages or especially electricity blackouts throughout the country.
Yeah, there's a very tight inverse correlation with the trade deficit as well when it comes to that. So I put a chart in the nest that people might find helpful. I do look. When it comes to Japan, everyone is always, I feel, not here, but in general, everyone's always trying to get me to be super doomy about it. And I always just look, I think if there's a country to be doomy about, I think it's Great Britain. I think that the chance of like a full blown currency crisis, sovereign debt issue, it comes out of UK, I think is way higher than Japan, like significantly higher. I think, especially given what's going on politically over in Great Britain, because they have every issue that you just laid out very eloquently. They have all those same issues when it comes to not necessarily as much on the food side, but definitely energy. They've had suicidal energy policy, shutting down the North Field and such, and they run huge fiscal and current account deficit. They are a very large twin deficit nation, and they're not the reserve currency of the world, right? The pound it used to be, but it's not anymore. And so, they are already kind of in that twin deficit, even larger at some points than America. They're already in that bucket. And then you add in the fact that half of their GDP is coming from government spending, right? And they are running just ever larger fiscal deficits, trying to tax their way out of a debt issue, right? Every kind of major developed market, it has a debt issue, and that will turn into a currency issue depending on how they handle it. Well, in Great Britain, they've tried to tax their way out. And if you look at tax revenue as a share of GDP, it's actually gone down over the past 9 to 12 months. They have actually had tax revenue as a share of GDP actually decline. So they're they have half their GDP coming from government spending. They have this hugely bloated fiscal budget, but they also run a very large current account deficit as well, requiring, again, foreign financing. And you're looking around at some of their political decision going, I don't want to fund that. I don't necessarily want to buy gilts right now. You look at the pound over the past couple of days, it's been kind of down only, especially today. Is really making a pretty sharp move today. So I would just point that out and kind of flag it. I think a country like UK, where they are heavily reliant on energy imports, they have a huge debt burden, and unlike Japan, where we went through all that, whether it be savings, whether it be the net interest income into the FEFSA, all that stuff, UK does not have any of that buffer or offset, right? It is pretty much just all bad in the UK. Their GDP right now is only running at 1% and they're talking about 2 to 3 interest rate hikes, 25 bip hikes. That'll certainly plunge them into recession. Well, in recession, by definition, the fiscal deficit widens, especially as a share of GDP, which is kind of really what matters. So, you know what I'm saying? Like, I think a country like that is far more at risk of a currency crisis. And we've seen it before, too. Just what, 2 years ago? Maybe 2.5. I don't know. Time's all screwed up. But the Liz Truss moment, right? Like, we just saw it not too long ago in the UK, where you had 30 basis point moves in their 10-year gilt in a single day. The pound was just like dropping through the floor. That kind of thing is appearing to be more common. And politically, like, I don't want to go down a political road, but like, you look just kind of objectively, at least from a macroeconomic lens, at their policy over the past couple, decade or two, and you look at like the prospect for the future of where they might be headed if reform doesn't get in, and it's ugly. Like they had much less energy reliance, or much less issue with energy. And then they decided to shut down the entire kind of their portion of the North Sea that was a buffer, to provide a buffer to that reliance on energy imports. Like, they have raised their tax rate. They have tried to tax their way out of a growth problem, which never ends well, because everyone knows, especially Bitcoiners, that is the way to get lower growth, not higher growth. Taxes are disinflationary and even outright deflationary if they're high enough. And you have this bloated fiscal budget, right? You have a current account deficit that is quite large. I mean, really, truly, like, quite large for a country that is not the reserve currency. And I think, I look at Great Britain and the UK, and I think if anywhere is going to have kind of a crisis moment, a currency crisis or something like that, I think it would be the UK over Japan. And I would also put France kind of into that same bucket as well. They don't run nearly as large of a current account deficit generally, but I think that they're kind of up there in terms of risk. Ironically, all the PIGS countries, Portugal, Italy, Ireland, Greece, and Spain, all the countries that already did the debt crisis, in the early 2010s, like they look pretty good. They look pretty appealing, especially Spain. That's one I've been keeping my eye on for the past year and a half or so. So you're kind of in this weird situation where you have pretty much every major developed market. We're talking about Japan, but also, of course, America, and then the UK, France, Germany. We have this large debt burden, China as well. We have this very, very large debt burden. And, the countries that kind of already went through the crisis are arguably poised. They already dealt with the issue, and they're poised to, I think, outperform the countries that have a high debt load, like the US, like Japan, like Great Britain, China as well, right? Although they're able to run utterly insane current account surplus. But if you'll notice, no one's talking about it, but dollar yuan, my favorite thing to point out to people, ever since Liberation Day, it has been straight down. And this is abnormal for the Chinese, who fix their currency, right? It's a managed currency, manipulated currency, whatever you want to call it. They have allowed the dollar to weaken or the yuan to strengthen. Now, it's got a long way to go to get to fair value, but I think that is, a pretty interesting development as well. You had Scott Bessent earlier today talking about, that the structure of China's economy is too export reliant, to that labor as a share of GDP and consumer spending as a share of GDP is too low and needs to be higher. And Chinese have talked about internationalizing the yuan. They've talked about trying to stimulate domestic consumption and kind of turn their economy into something much more akin to America, right at the time that America is trying to turn, maybe less huge twin deficit and reliance on manufacturing, right? Try to reshore some of that. We have the in my opinion, high likelihood that over the next couple years, we get some kind of Plaza Accord 2.0. And that, of course, is going to include Great Britain, and the Eurozone. It's going to include China. That'll be kind of, I think, the main focus of it. But it'll also include Japan, and I think that Scott Bessent really would like to see the dollar weaken versus the yen, where purchasing power parity, fair value for the dollar yen is like 110, 115. That's a lot of yen strength that is kind of in there potential. And it really, in my opinion, I think that the concerted weakness is, like Roberto said, with the energy story, but also the interest rate differential story. They have to get interest rates higher, and Roberto pointed it out earlier. But the JGBs that the domestic banks and insurers, pension funds are sitting on, look, you might have an issue. Just like we did in America, right? We had 3 of the 4 largest bank failures under the last administration due to the fact that we hiked rates. You could get something like that. Japan is ultimately going to be faced with that kind of decision. Do we let the pension fail? Do we let the bank fail? Or do we go back to kind of everything that kind of started it? So, but as I think we've mentioned pretty well, you don't hear it mentioned very often in talk about Japan. They do have buffers, right? And there are positive attributes to Japan that don't get, I think, discussed enough, versus a country like UK, where they have none of that, right? So I would keep my eye on the UK for sure.
Robert, I would say my intern actually is not here in the spaces, but he's a UK college student, and learning about the UK economy through him, and both anecdotally and also through some of the research he's helped me with, has been pretty incredible. Um, I'm not sure if you know this or if you've heard of this stat, but if you stripped out London from the UK, the country would have a lower GDP per capita than the poorest US state, which is Mississippi. So basically, the entire economy is just propped up by London and the major financial centers and like the few tech companies that still have headquarters in the UK. The other thing is
That
that,
old City of London stuff.
yeah, oh yeah. They're controlling everything. Don't you know that? Um,
Yeah.
yeah.
That does actually tie into the Strait of Hormuz, though, because they were the ones insuring everyone, all the boats coming through, and then that was one of the main reasons the boats couldn't go through, not because it was necessarily more dangerous, but just because their insurance skyrocketed so much.
So Roberto, I'm curious what you think about this. I haven't asked. Do you that whole kind of 4D chess with the City of London and the insurance? What do you think? What do you make of that?
I mean, I think that that's a bit ridiculous. So for context for everyone who hasn't heard about this, but I think it's mainly Tom Luongo, but there's some other people who also report this theory that basically the City of London, via old colonial money from the 17 and 1600s, has inordinate influence on U.S. capital markets and U.S. financial institutions, and is able to manipulate global markets in a way to benefit London at the expense of the U.S. And it's mainly like framed as a power struggle, right? And so one of the main battles that he and others have stipulated has occurred was between LIBOR and SOFR, which LIBOR is the London Interbank Lending Rate, which basically was the bankroll, what did you say, like the bedrock rate for, or the benchmark rate for all of euro dollar debt globally. So if you were lending money, from a German bank in USD to a Pakistani, mining manufacturer, mining tool manufacturer, you would generally do it in US dollars, and you'd base it as LIBOR rate plus or minus a certain amount. Now, obviously, since I believe June of 2023, that has switched to SOFR, which is the secured overnight financing rate, which is basically set by 3 different repo rates, including GCR and I believe Fed funds and one other rate, might be repo rate. And so it's taken away the power of that, fixing that interest rate from 7 London banks, which is what it used to be, to now uh, basically like a floating average of 3 different US based repo rates. I'm not saying that there's no obvious, you could say, contention between European finance and American finance, or between specifically UK interests and American interests. But to believe that the City of London is the main controller of the last, 50 years of global finance, I think is a little
And
hyperbolic.
yeah, and there was, of course, the LIBOR fixing scandal that people can Google and look into. But yeah, no, I think I heard that a lot, especially in Bitcoin kind of arenas, and I just thought it's just a little much to believe that that was really the reason that we went and not only that, but that we wanted the Strait of Hormuz to be closed, right?
Mm-hmm.
Which was like insane. When you think about the second, third, fourth order effect of a closed Strait of Hormuz, it's like, wait, have you guys thought out what that really entails? Because that's going to cause, an economic slowdown akin to Q2 2020, right? Like if Q2 2020 and the global lockdowns, we had demand for oil decline by 22 million barrels per day, and 20 million barrels goes through the strait. Well, if that theory is correct, you engineer a global economic slowdown in the aggregate on the scale of Q2 2020. And you think that the US is going to survive when we have a net international investment position of negative 91% of GDP? Foreigners own $69 trillion of US treasuries, US equities. We know in 2022, with the energy shock then, that foreign US treasury holdings declined between Europe and Asia by $600 billion. Now, some of that was mark to market, right? Treasuries fell and yields rose. But some, hundreds of billions was outright selling to finance the dollars for the energy. And not only that, but equities declined by like 1.2, 1.3 trillion dollars. Again, some of that is mark to market, but what you get foreigners dumping that many US treasuries, again, the net international investment position, negative 91% of GDP, they can dump a lot of US treasuries, a lot of US equities. Well, you dump US treasuries, you create a debt crisis here in America, and you dump stocks. That is the marginal driver of consumer spending for the upper 10% who drive half of consumer spending, which is 2/3 of GDP. So you just took out a third of GDP because stocks start going down. And that's to say nothing of the capital gains tax revenue hit, right, which is a large driver of government revenue, and stock-based compensation and leverage and all that kind of stuff, S blocks and all that. So I just I think people hadn't really thought it through, because like, okay, yeah, I get it. Maybe, on the first the first step, I'm kind of with you. I could see it. But then you start playing it out. It's like, how would that be good for us? If anything, it's just I just, it was kind of one of those moments where you just laugh,
Yeah, well, more so like how would that be good for the quote unquote City of London, right? And these international British bankers that are supposedly controlling finances, as the proponents of that theory say.
Well,
You know,
I
like,
think they were saying that we were trying to wrestle the power from the city. I think.
Trying to usurp control.
oh,
Yeah, I
usurp
think that's
control.
Yeah.
Okay.
yeah. Or, like you said, maybe they're just engineering another global crisis like the COVID, like the lockdown. I'm not sure. But I'm not really into that theory either. Anyway, I was just kind of playing devil's advocate there.
Well, yeah, I mean, look, the hantavirus thing, like, I don't, in the macro world that I live in, I don't hear a ton of people talking about it. So I'll just kind of like flag it. I was doing some research on it, and I was following COVID from the very, very early days, like early January, where Zero Hedge was like one of the only people reporting about it. So I'm used to reading those kind of publications, and I was reading about the prior outbreak of the Andes virus. It's really important people understand Andes is different from hantavirus. Hantavirus is a huge group. There's like 70 different viruses that are hantavirus. And most, or pretty much all, except the Andes, are not human-to-human transmissible. Well, the Andes is what we're talking about here. It's got a month-long incubation period. There's asymptomatic spread, which we kind of already know that that's already been confirmed by an official, I think at the WHO. And not only that, but the case fatality rate is 30%, even as high as 40. And then you add in that it has a R naught, or transmissibility, of 2.0, 2.1, according to what I read. That means for every one person that gets it, two people get infected. Like, that is everything that they told us COVID was, right? We know, I think most people on here probably are in the same boat. It was a total scam, right? 2020 and all that. But like, this could actually be, that's the irony of it, is like they wasted, it's the boy who cried wolf. They did all that for a cold, for a common cold. And now there's a very, I'm not a virologist, I'm not a doctor or anything, but I did just kind of want to flag it because the similarity, and some of the oil guys pointed this out. Look, how do you destroy 20 million barrels per day of demand? Well, virus, a bad one, where you have to lock down the global economy again. That would destroy 15 to 25 million barrels per day of demand, and there you go, problem solved. So just something for people to think about. I've just been kind of like putting it out there, not making any definitive claims or anything, but like, it is something I'm keeping my eye on, because if we were to get a negative growth shock like that, like another COVID, maybe even more draconian, I think that would have major implications for Bitcoin, for the stock market, for debt. We're talking a lot about bonds and the sovereign debt market in various different countries. I think it's something worth kind of keeping an eye on.
We also have, I know the space is wrapping up, but Simon Dixon just joined. Hey, Simon, nice to see you.
Hey guys, how you doing? Sorry, I was just listening in. I think just was going to chime in a bit on the. I do think that the whole argument of City of London versus America just doesn't add up when you go through it, because the City of London and New York act as one block, and so if you were to think of a conspiracy of how what I always call it, the financial industrial complex, a complex just like a military industrial complex. It's a group of companies: investment bank, retail bank, asset managers, private equity, venture capital. But if you take that block and you look at most of the crisis and the events leading up to crisis, whether it be ESG and whether it be carbon neutrality and whether it be renewable energy and all that stuff, you can find a thread of conspiracy. And if you wanted to look at who benefits from this, you could see that OPEC as a block, and the companies that big oil and big energy, you can see how they completely benefit from a manufactured crisis. And this will create a global reset that will transfer significant wealth upwards. And if they know that the end result is a big print and a socializing losses and privatizing of gains, which it inevitably will be, then that's just another long-term capital management, another global financial crisis, another COVID, another Russia, Ukraine. And this one's like an acceleration cycle. And so if you do actually look at the practicality of why the Strait of Hormuz is closed right now, unless you're a nation state and you're willing to take the risk as a nation state for your shipments, then you need to get insurance, and that does require Lloyd's of London, which still dominates. And you need to get permission or something that would satisfy Lloyd's of London that America is not going to take out your shipment, and something that satisfies Lloyd's of London that the IRGC is not going to take out your shipment. And so given all of that, that's what it was required to get a shipment via the Strait. And other than that, it's closed. And so if you can't get, insurance, nation state approval, and IRGC and America assurances and guarantees, then your shipment's not getting through. And so there is a route to get the shipments through because they have got to Pakistan and they have got to India when they needed to. And so there is a level of coordination to actually, we are in a situation where very, very specific vested interests, in fact, the most powerful interests in the world, both technologically, financially, militarily, and energy, are all benefiting from a manufactured crisis. And that's why stocks are at all-time highs. That's why we're leading to a narrative that can lead to a big print. And so to me, the conspiracy is the only thing that makes sense. Nothing else does make sense from my perspective.
And the other thing, just to quickly point out with regard to the Strait of Hormuz, Simon was way ahead of this, ahead of all the experts that you get on CNBC and Bloomberg and stuff. All the GCC are pegged to the dollar, right? And that normally makes sense. That is the petrodollar system where oil sold in dollars, dollar revenues come in, huge amounts of dollar revenues come in, they get recycled back into US Treasuries. Well, the part that people leave out is the petrodollar kind of agreement, right? The final piece was we, America, will provide security. And you look at some of those countries and the amount of infrastructure that was damaged, critical infrastructure that was damaged. I don't know, if I was in the GCC, I might be heavily rethinking that petrodollar arrangement. And again, what does that mean for the dollar? What does that mean for interest rates? What does it mean for Bitcoin? Right? When you have an erosion of the king, right, the dollar, you have an erosion of that. So far, it's been gold. But I think that, just to kind of finish up, I think that I'm starting to see more and more a world where Bitcoin emerges. I think it'll take, I don't know, 2, 3, 4, 5 years. But I am very bullish Bitcoin. First, it was gold. That's taken a breather. And then with the Strait of Hormuz, it emerged, Bitcoin, right? Where it's like, oh, pay the toll in Bitcoin. And you think about it, you're like, well, yeah, if I'm a ship owner, and I got to pay a toll to a sanctioned entity that is currently at war with the US government, how am I going to do it? Yeah, I could do gold, right? I could get transport gold on my container ship, bullion, and then, I don't know, ferry it to the IRGC naval port, or I could just tap some, buttons on a screen and boom, Bitcoin's there, 10 minutes, So I think that, what the silver lining from the entire conflict is seeing that kind of glimmer of hope with respect to, what in the world, in the aggregate, what is used as a reserve asset, not a currency, right? Because transaction is different, in my opinion, than what is held as a store of value. I mentioned earlier, the U.S. Treasury was in a bull market for decades, and it made sense, right? It held purchasing power for relative to the critical things that a country might need, like Roberto was talking about, food, energy, and the U.S. Treasury kind of did that, right? But we have broken that, 50-year bull market in treasuries. And we're getting to a world where, first it was gold, but I do think that Bitcoin is going to play an ever larger role in those kind of discussions. I think people focus too much, maybe not here, but, I hear a lot of people focus on Bitcoin as, I go to the coffee store to buy a coffee with Bitcoin. It's like, no, man, that's not, that I look at it much more like bank reserves or like gold, being held in a country's FX reserves. That's where I think Bitcoin is really going to emerge, but it has to get a lot bigger. And what that means, for the people listening is the price has to go up a lot, right? And I think it's very bullish Bitcoin. I think the reorientation that I mentioned earlier with China and America, right, kind of swapping position, right, where America's trying to reindustrialize and China's trying to turn more into consumer, domestic consumption kind of economy. I think that that's very bullish for both gold and Bitcoin. I think that, all of this stuff that we have discussed, whether it be with Japan, whether it be with the UK, whether it be with what's going on in the Middle East, it's kind of all bullish Bitcoin. And I'll point out that like during the conflict, Bitcoin outperformed gold by 18 to 20%, depending on when you stop the calculation. It outperformed stocks by, I think, 16%. It outperformed US Treasuries pretty dramatically, and it outperformed the dollar. So it outperformed everything, including that kind of traditional safe haven, or at least what had been the safe haven. So I think that that is really notable, and I didn't hear too many people kind of really hammering that point home. Sure, we didn't get a parabolic move, like we're used to with Bitcoin. Sure, we didn't get that, but like when you look at it relative to these kind of other neutral, I mean, the SPY is not, and treasuries are not, but you look at it relative to gold, and the fact that we outperformed over a month and a half, 2 months, 2.5 months by almost 20%, I mean, that to me is extremely notable. And I didn't really hear enough people putting emphasis on that. So just a little bit of bull fuel, I guess, to end the show.
Yeah, I've seen some data recently showing that obviously not only is part of that divergence in price performance just due to how overbought gold was by the end of January, with the massive blow off top we saw in basically all precious metals, but also the fact that there were Middle Eastern states that were selling gold as a way to raise capital,
To
raise
defend the
liquidity,
peg.
yeah, to defend their pegs. But also, there's another untold story which I haven't really seen many people talk about, which is Iranian citizens, especially as the war was launched in late February, started buying Bitcoin in large amounts in order to transfer wealth outside of the country, right? For a country that's cut off from SWIFT, which is the global, telecommunications network that basically ties together all banks and makes it easy and convenient to wire money in between banks, to for those citizens who are caught in a system that's basically locked out of the global economy, it's very difficult to transfer money, and you don't want to hold the domestic currency because it's essentially been hyperinflating for the last few years, and it's obviously gotten exponentially worse over the past month and a half. I think I saw a figure saying that their monthly inflation figure was reaching 35-40%. And so that's very close to hyperinflation figures. And if you want to preserve value, then the logical option would be Bitcoin. And this one guy I need to find the post on Substack again, but this one guy was using on-chain data and trade flows to track like huge purchases of Bitcoin, especially as the war was started and as different events of the war, started to escalate, like the closure of the Strait and, bombing of not only Israel, but also Saudi and the Ras Tanura refinery and Kuwait and some of their LNG refining facilities. There were huge purchases of Bitcoin around that time, and then transfers of that Bitcoin to other wallets, which seems to be coinciding with, Iranian money trying to leave the country.
Yeah,
And so I think that's something that has been mentioned.
Going back to the start of the year, the Iranian rial is down 97% relative to the dollar. I mean, when you said hyperinflate, like, just so people know that you weren't exaggerating with that.
Yeah, I want to throw
No.
to Simon. I see your hands up, but I just wanted to mention real quick. We talked about that too on our channel about how Besant openly talked about Operation, what was it, Economic Fury, to try to destroy the real was done completely on purpose and was sort of a precursor to the war, causing their population to go out and protest and causing unrest in the country.
They did it to Turkey, Venezuela. Simon knows, this is a known thing that they will do to weaponize. And again, going to my earlier point, sorry to jump in, but going to my earlier point, that is just more fuel to get away from the dollar, right? The fact that we have weaponized the dollar to take down entire economies. I mean, imagine the millions of people that we have harmed in Turkey, in Venezuela, in Iran. I mean, the list goes on and on. That is just more motivation if you're a sovereign to get away from the dollar.
Yeah, absolutely. And if you look at the largest sovereign Bitcoin miners, it's Iran, Russia, and UAE, which is no coincidence. And firstly, none of this is advice around circumventing sanctions. We're just discussing what people do. There are serious consequences in circumventing sanctions, and no one should do it. But we're just discussing the monetary flows. If you want, so China is very protective over their currency. They don't want, for this very reason, this is why they've got severe capital controls, because they went through a century of humiliation and they know every tactic and they know every war and every opium war. There was a currency war that predated it, and it still happens today. And Scott Bessent knows it very well because he worked for George Soros, and George Soros was attacking the Great British Pound. That's not so great during the time of the euro. And if you go to every war, I actually did this. You can see the currency war before the war because they tried to impose severe economic distress so that the population can lose all their savings. And once you lose your savings, you have a dissatisfied population. And then the media machine kicks in and you manufacture a story. And Gaddafi, the biggest thing that he did was create a gold-backed currency. But where this becomes really interesting is when you look at how it's actually done now. And so if you want Chinese yuan, then one of the only ways of doing it is by giving the Shanghai some gold, because Shanghai wants gold from wherever it will come, because they know that the West has got paper contracts against gold that can't be serviced. And the central banks lend gold every time there's a crisis, but the paper contracts don't exist. So Shanghai wants that gold because it doesn't have paper contracts against the gold. And so that gives it significant leverage in many of these negotiations. But if you want Chinese yuan, then you have to deposit gold in Shanghai. The way to get gold in Shanghai is via either Hong Kong or UAE. Those are the main mechanisms. And so if you want discounted oil and you're India and you've got dollars, then you can take your dollars and you can buy gold at UAE. And then UAE provides the sanctions circumvention mechanisms for Iran. And so when we're told that Iran and UAE are at war right now, you understand there's a bit of theatrics there because UAE is the second largest trading partner after China to Iran. And those routes exist for a reason, and they're not about to go anywhere. And so by implementing sanctions, you can get discounted oil. You can take that gold, you can get the oil, and then China will purchase that oil in exchange for gold. And then you have to have these shipping routes in order to actually get the physical gold away from London, away from any of these centers, or away from America and over to Shanghai. Like that's literally, and then they create in exchange for that, you have to connect to SIPs, which is the alternative to SWIFT. And then UAE took over the Bank for International Settlements project of a network of central bank digital currencies between Saudi Arabia, UAE, China, Hong Kong, and Thailand. And so you realize that UAE is playing every part. And so when it leaves OPEC, the story was that they're in financial distress, and yet they've got 170, I think, over 200 billion of dollars and $2 trillion of assets. And so what did they get? Effectively, Scott Bessent was saying, you can't sell your equities, you can't sell your treasuries, so we'll give you an FX swap line. And now they've got direct access to create dollars with their own currency in a Fed-backed system, which was an exclusive club before. So now they've got the integration into the Fed system with the FX swap lines, which was before just for Europe, UK, Switzerland, Canada, Japan. And they've got the network of central bank digital currencies. They created crypto slash Bitcoin capital. They started mining Bitcoin. And they've got the whole rails for the sanctioned circumvention routes for Russia and Iran. And they're integrated into the SIP system, which allows you to buy your imports from China and get access to Chinese yuan via the gold markets. And so when you do that whole circular flow, kind of puts a new spin on what's really happening in the Middle East right now, because a lot of these routes are being renegotiated. And coming out of OPEC wasn't a sign of breaking OPEC. It was breaking OPEC because it was the other half of the petrodollar. And so if you break the other half of the petrodollar, you look at what did they negotiate 11 months prior? Well, it was an energy agreement network between BRICS members. And who were BRIC members? Iran, Egypt, UAE, and then Saudi came in as like an observing member. So when you follow all of these routes, geopolitics starts to make a lot more sense. And it's often the complete opposite of what we're fed as a story. And I'll leave that with you.
And not only that, but gold and Bitcoin, right? To what Roberto was talking about earlier. If you're a sovereign, you want something that will increase your purchasing power of the things you need, right? Energy and food for Japan, for example, what we were talking about earlier. Well, look at the Bitcoin oil ratio. A lot of volatility, but generally that is going to increase your purchasing power over time. And gold, the gold oil ratio is one Lou Groman talks about often, but that has started to really, really move again around the same time that we quote unquote froze the Russian FX reserves. What that means, by the way, is we defaulted on those U.S. treasuries that they held. People don't phrase it that way, but that's what we did. Around that time in 2022, you saw gold to oil ratio go vertical. You went from 20 to 80, and it's come in a bit. But over time, that is really kind of the key. And that is why I think things like gold and Bitcoin are going to have such high demand, is given the fact that they hold their purchasing power for the critical things that we were kind of talking about earlier with Japan.
And very importantly, one quick sentence, I'm sure you're wrapping up, but the stable coins were taken because they contacted Tether. The DeFi contracts, after several hacks happened, they were, Arbitrum came out and effectively pulled the freeze function on the foundation level. The only thing that couldn't be taken that still flowed was Bitcoin. And so Iran still has all of its Bitcoin. And therein is the story of how Bitcoin is different. And when you look at how clunky getting gold around the world is, you soon start to realize that there are very high powers that still want Bitcoin as a final settlement layer to exist for very, very specific reasons by very, very powerful people.
A couple of years ago, I read this really good book called Treasury's War by Juan Zarate, who's a former undersecretary to the U.S. Treasury and a senior White House official. And he laid out basically, the U.S. playbook post 2001 of, weaponizing the dollar and the SWIFT system against perceived enemies, right? Not only do they have access to, obviously, the SWIFT network and inordinate let's say, influence over SWIFT, even though SWIFT is supposedly a neutral group based in Switzerland. But they also have the OFAC list and Section 311 of the U.S. Patriot Act, which allows them to designate certain, non-U.S. based financial institutions as aiding or abetting terrorist or, money laundering activities, which basically they can weaponize that and use that to cut them off from U.S. correspondent banks, which means for a foreign bank, right? Like if you're trying to transact in dollars, you need to have a correspondent bank with a branch in the U.S., or you need to have your own branch in the U.S. in order to settle through the FedWire system, or through at least some extension of FedWire through some related bank. And they use that to great effect throughout the 2000s and 2010s to basically stop a lot of foreign adversaries from using not only their national currencies or their national trade flows, but even private entities. Right, in 2014, there was a case against a French bank, blanking on the name, but the U.S. Treasury threatened to fine them $50 billion if they did not comply with U.S. sanctions against Iran, because the French bank was providing basically financial loans and equity financing to a couple Iranian oil and mining companies. And even though France did not have any sort of, let's say, embargo or any sort of trade deal against Iran, or any sort of regulation against trading with them, the French bank was forced to acquiesce and to listen to U.S. Treasury sanctions. And so the U.S. has been using this playbook for a while, and I think it's not surprising that Iran and others have finally found their way around it. But I guess my question is, based on that network that you laid out, Simon, who do you think is going to stand to gain the most geopolitically from this crisis, right? It sounds like China has a huge leg up here, because not only do they have the CIP system, but they've also been trying to make inroads via the One Belt, One Road initiative. They've been trying to do mining-linked loans in Africa. I believe they're Chinese ICBC, which is one of their commercial banks that does business abroad, obviously state-run, has done like $30 billion in mining-linked loans in Africa. They've been doing swap lines from yuan to Egyptian pounds. They've been doing deals with a bunch of Middle East as well as Central Asian and African countries in order to get exposure to, especially raw earth minerals, or to key commodities that are needed for Chinese manufacturing. But they've been trying this for years, right? And it's very difficult because China has generally a closed capital account, and so to encourage foreign trade in yuan when their own capital account is closed, and it's not even easy to transact cross border, especially as a non-Chinese citizen. Do you think that they have the most to gain, or do you think there's another country that's going to try to take advantage here?
Yeah, I think as a nation state, China is the one that has the most to gain. I think Russia is kind of piggybacking along. I do think Iran, will come out of this with sanction relief at the end of it, and a very favorable deal, as long as it can be handled by China and normalized with the Gulf countries, which I think is China's role. So I think everything you're witnessing is China's plan. And then the other side of the winner is big oil, big banks, big tech, and elites, basically. And so the net winner is a bunch of companies whose market caps are going up, whose share prices are going up, and they are concentrating power. And the average person is going to be forced to sell their assets because they're squeezing and outpricing people, and they want everyone to sell their assets. The small ones, because power is concentrating upwards and it's going more institutional. So if you don't own assets, you're going to die in this economy. Like, you're on the wrong side of what's happening. But because I don't look at, although the story is that America benefits, which is true if you understand the real power of America. And the real power in America is an elite group of companies that dominate the S&P. And the average American is getting wrecked by this. But elites in America, elite corporate interests, let's call them globalists, whatever you want to call them, they're crushing it. They're doing incredibly well. So this is a ginormous wealth transfer exercise, just like COVID was, just like the global financial crisis was. So the winners are the asset holders of those companies and China. And I think Iran and Russia will come out on the other side of this aligned with a very, very different version of the world.
Yeah, dollar ruble exchange rate. We were told that we were going to crush Russia, right, into oblivion. We were going to absolutely annihilate them. If you look at dollar ruble, we're right at the same level. It's gone nowhere since we imposed all those sanctions and kind of really went after them. The exchange rate hasn't moved. Volatility within there, but like over time, settled out, hasn't moved at all. So, I think that there's also kind of an argument to be made that we might be losing, a lot of the strength that we might have used to have. And the more that the more that the rest of the world diversifies away from the dollar, the more that kind of power, I think, diminishes. And we see it with Pax Americana, which is basically, dead. That was, we can guarantee that global trade. We have a large Navy. You don't have to worry about it. We'll take care of that, secure global trade. Strait of Hormuz, arguably the most critical shipping lane, or one of the top three, has been closed effectively for 3 months? So I don't think that Pax Americana, the death of Pax Americana, I don't think that that's adequately kind of priced into gold, Bitcoin, or the DXY.
I tell you who the winners were. They all met in Shanghai or yesterday. So if you look around that table, you've got the Chinese Communist Party, you've got Trump's personal wealth, and you've got a bunch of executives of the most powerful companies in America. They are kicking ass. And they don't mind how long this carries on, as long as it's bounded escalation, as long as the 30-year yield doesn't blow out, which is getting to that 5% mark, as long as oil stays within the acceptable parameter of wealth transfer rather than complete destruction. But even if you get to destruction, I think they're okay because they know the Fed's going to bail them out, and so they're crushing it. And they were all in Shanghai, I think, celebrating how much money they're going to make at the expense of the people.
Jensen couldn't even be bothered to wear a suit. You know what I mean? That was, I don't know, maybe I'm just autistic, but I saw him wearing a leather jacket to one of the most critical, bilateral meetings between two of the two largest powers in the world. And he showed up in a leather jacket, like that. I think that was really, illustrated the amount of arrogance and to your point, the amount that is really who drives U.S. politics. And it's I hate to see it because it's everything that Trump said he was not going to do. Trump, the Senate, all of them, right? They were saying all the right stuff in the beginning. And Simon, I got to give him credit. He was pushing back on me years ago when we would be in the morning finance space. He would always push back, and he was much more skeptical. He ended up being right, and I ended up being wrong. It's really just unfortunate. You look at that kind of, some of these Mag 7 stocks are just like, it's mind numbing. I sit there and try to think about it, but it's beyond comprehension. What is, and we're watching it happen like right in front of us day to day. You know what I mean? We are watching that kind of ultimate wealth transfer. We are in the AI revolution that is going to cause productivity gains to they were already not flowing to the average American, right? You look at real wages relative to U.S. productivity. Real wages since 1970 are up like 4%. Productivity is up like 100%. I forget the exact numbers, but ballpark, right? It was already bad. But then you throw AI into the mix where, 5 companies are going to gain, an ever larger share of it's crazy to watch in real time, given, some people like Simon have been telling us this is what's going to happen. and you watch the valuations every day just go up and up and up. And I'm not like a super AI doomer, but I do think that it's going to cause real productivity gains. But what does that actually mean for the average American, right? If the average American benefited from productivity gains, things would be great. I would be in favor of AI. But we had a productivity boom, and we know how it's going to go. It was called the China shock, and it was China's admission into the World Trade Organization in 2000. And we saw what those productivity gains did to the median American. Deaths of economic despair are 3 times higher today than they were during the Great Depression. You know what I mean? Entire region of our country was hollowed out, thoroughly hollowed out in the Rust Belt. You had the OxyContin and opioid abuse skyrocket. You have Men Without Work, a great book that I need to reread. But Men Without Work, and permanently out of the labor force, and just depressed on drugs. Half of them were taking opioids for some kind of pain condition or illegally. Right. That's what the productivity boom of China shock delivered. Oh, and by the way, also some very cheap Temu Alibaba kind of trinkets. Like, was that really worth it? I look ahead, to the future, this kind of future with AI, and all I can think about is a repeat of the China shock, but this time, instead of the blue collar people, blue collar men getting wrecked in the Rust Belt, instead of them, it's going to be the kind of entry to mid level white collar workers that are much more, metropolitan. They tend to be much more liberal. So then I think through that, okay, well, if a bunch of kind of middle to upper middle class liberals in kind of the major metropolitan centers of America are starting to get their job taken by AI, what do you think they're going to vote for? Politically do we end up in that world? And like, I think this stuff through, and it's I just don't see the kind of optimistic or rosy outcome to this. I just see it getting much worse. Like, people talk about the wealth divide being worse than it was during the Gilded Age. I talk about that a lot, but we talk about this, but like, it's probably going to get worse, which is crazy to think about. And ultimately, it will end. The stuff that I think Simon's been talking about, it'll end one way or another, either violently or politically, through a relatively peaceful kind of mechanism. But I think it's got, some legs to it before the real hard consequence kind of really comes in and try, can we even correct that monumental sort of force that is AI? Can we even do anything about it? I think, it's kind of like cat's out of the bag, and, it was learn to code. Well, oops. Now, now all those jobs are gone, taken by AI, so I don't see how any of that kind of stuff gets better. If anything, I just see it getting worse.
Yeah, you definitely got to lean into AI. That nothing stops this. Like, you got to embrace it, lean into it, make as much money as you can in this transition, and just save it in hard assets and become an asset owner. Like, just work as hard as you can for the next 3 years to bring in as much income as possible. And if you've got to arbitrage, I know if you've got families and all other, there's like moving homes and stuff is not really a thing, but if you're young and you can arbitrage, like, to me, I cannot, like, I can confidently say I think the worst thing you could do for the next 3 years is get a college degree and go to university. Like, you just got 3 years, get as much income as you in, master AI, help as many businesses and people make that transition, or transition your own business, whatever floats your boat. But even if you're in a startup world, like, make sure you're focusing on personal income as well. Like, normal startup, you don't get paid for years, and you put everything in the business. But you've really got to think about your income and building assets. Every single month you have to have, more assets. Otherwise, you're just going to be crushed and on a UBI at the end of this when I work through like the logic.
Yeah, and you don't want to own the S&P, right, the SPY or the QQQ, because how are they going to fund that UBI? I agree with you, kind of inevitable UBI at the end. How are they going to fund it? If not a windfall tax, a huge astronomical tax on Google, Meta, Microsoft, all the hyperscalers, which by the way are 40% of the market cap weighted index. 40%, which historically is bubble territory, right, and near the top. How? I mean, I guess they could just print the money, but like other than that, which would cause very high inflation, although I wouldn't put it past them to do that. Outside of that, the only way I see to fund it is a huge tax on the very companies that are propping up the S&P 500, NASDAQ, that kind of thing. Well, you start taxing them and their margins, get halved. What happens to the stock market, right? And all the value there that is being held by, retirement, in your 401k, that kind of thing, pensions, right? Like if I just don't see another way to fund the inevitable UBI other than a tax on the very companies, a pretty large tax on the very companies kind of holding everything together. Because the stock market being up is kind of what's holding together GDP, and the AI capex as well. You take the AI spend, out of the GDP calculation, we're basically at zero. You know what I mean? So I don't know. I try not to like be a doomer. I kind of hate that word, but I try to look at things rationally, and I just don't see kind of the rosy, how this all kind of works out. It's no big deal, and we're better off in the end. I don't see it.
Robert, how do you see this whole 5% on the 30-year working out next?
I don't think it's danger, like imminent crisis. I think that 5.5, or 6. I think that's kind of much more like oh shit. I think the 10-year probably matters more. Right now I think 4.5 kind of what might have been the level at which stocks start to have a hiccup. But people are starting to move that target higher, somewhere more like 475 on the 10-year, which if you look at the equity risk premium, it is at the lowest level going back like 25 years. So I think we're kind of like, in my opinion, we're already at the level where equity should be correcting, but we've been driven by one of the largest gamma squeezes probably in world history on the indices. So, I think 4.5 on the 10 years kind of maybe like the beginning, but 4.75, I think that's really where, you really see equity weakness, if I had to guess.
Do you think the equity side is kind of just people don't know what to do, so everyone's just going into like S&P 500 ETF, and that's it? There's just a structural bid that is not going.
I mean, there is Mike Green. I know he's like anti-Bitcoin, but I think he's pretty smart. I like a lot of his work on passive. I think that's some element of it. The passive bid is also inelastic within the passive bid. And I would recommend people, go read Mike Green's work on all that. So it's kind of reflexive, within the passive bid, there is kind of a reflexive feedback loop. But yeah, I think it's mainly gamma. I think it's mainly an options-driven chase. I always point out to people, just as you can have panic to the downside, right, where the thing is just going vertical down, waterfall kind of price action, just utter capitulation, panic kind of price action. You can have that to the upside. And I think that's really what is driven. If you look, the actual volume in the SPY or the NASDAQ, the Qs, volume has been declining the entire pump. So we've been moving higher on ever less volume. And if you look at some of the gamma, like dealer net gamma exposure, it was reaching historic levels. The put call skew as well. There's a chart that it was literally in the zeroth percentile. Like it's never happened before that we had skew that skewed toward calls. You had levered ETF inflows that were just off the chart. The 2x or 3x levered semiconductor, right? So you have that kind of dynamic, which in my opinion is not necessarily healthy or stable or anything like that. I think if anything, it's kind of the opposite. Because gamma squeezes can go both ways, right? Just as it can be a reflexive, vertical bid to the upside, it can be that way to the downside too. Equities just look really, really precarious. If the volume hadn't been declining this entire time, I might be sympathetic to the view that people are just kind of buying the SPY and the Qs to try to preserve purchasing power. But the other thing I'd point to is like gold hasn't really shown kind of a debasement trade kind of narrative. You don't see it in gold. Kind of, you could argue in Bitcoin, but I would argue the Bitcoin move is much healthier. And you don't really see it in the dollar. So I don't think it's a debasement trade kind of thing. I've heard that narrative, but it's not really. I think it's much more an options driven, just a very, very large gamma squeeze on a $6 trillion, actually, I think it's like $68 trillion asset, and that'll end at some point. Just like GameStop did, just like AMC and all those gamma squeezes in 2021 that I was a part of. They all end. And I'm not saying that we're going to crash 70% over the next week or anything like that, but I think that we're going to get a pretty healthy pullback because what has been driving it is not healthy. It's a bunch of out of the money speculative call buying and puts that are rolling off, and the deltas, and we have OPEX tomorrow. So I'd be interested to see kind of the price action after that. But yeah, I think it was much more kind of a technical, mechanical driven rally, which makes it, in my opinion, much more susceptible. When you look at the breadth, we have made 7 new all-time highs with negative breadth, where more S&P 500 components were declining than were rising. You have dozens of NASDAQ companies setting 52-week lows, if not an outright all-time low. And yet you look at the Qs straight up, so negative breadth, declining volume, the huge call skew, as well as the record amount of dealer gamma exposure. I think that picture is not one that would be reassuring if I was long the SPY or anything like that.
Yeah, that's a great point. I mean, I just saw today, right? S&P hit 7,500, first time in history, up 20% or 19% since the March 30th bottom, meaning an increase in total market cap of $11 trillion. That's insane, right? Especially given that we haven't had a material adjustment to the Strait of Hormuz. We haven't had any actual, final conclusion come with that geopolitical crisis that's been unfolding. There's been a ceasefire that happened for the majority of April, and then we've kind of rolled that back. Now there's new negotiations beginning again, and it seems that this crisis, like you said, is going to drag a lot further than people think, just because the Iranians, domestic missile defense and drone defense network has proven to be a lot stronger than people think. And yet SPY is literally going vertical for the last like 6 weeks. It's pretty insane. Guys, this has been a great conversation. We are a little over the scheduled spaces time, but thank you, Simon, for jumping on. Thank you, Robert, again, for coming on and chatting. This was probably the best spaces we've run so far. So really appreciate you guys. Everyone in the comments or in the audience, please follow everyone on stage. Simon's a Bitcoin OG. I've listened to him in spaces before. Really great analysis. Robert also puts out really good work on his YouTube channel. Also, his Twitter has incredible charts that a lot of people will steal sometimes. So if you ever see a chart, TradingView chart with like a lot of comments on it or annotations, that's usually Robert's. And then Bitcoin Well is the host. They're a Bitcoin exchange in Canada. If you guys want to buy some Bitcoin and self-custody it immediately, you can do it through them. Thanks, guys. I really appreciate you coming on.
Yeah, thanks guys for coming on. Thank you,
It was
everyone.
a great one.
Yeah,
Thank you,
thanks for having me.
Simon.
Really enjoyed it.
Sweet.
Awesome conversation, guys. Thank you.
Thanks, guys. Buy some Bitcoin, everyone. And I'll see you guys next week.